Indonesia's manufacturing sector shows signs of stabilization, PMI update. Brace yourself for a surprising twist in Indonesia's manufacturing landscape. Signs of stabilization are emerging, yet the sector remains sluggish and continues to contract. But here's where it gets controversial. Is this modest improvement really a sign of a genuine recovery, or just a temporary pause before further downturns? So, what's the current situation? In July, Indonesia's manufacturing industry experienced a slight uptick, with its Purchasing Managers' Index, PMI, climbing to 49.2. This number is an improvement over June's disappointing 46.9. Yet it still indicates contraction because any PMI score below 50 signals a shrinking sector. Factory output and new orders are starting to decline at a slower pace, suggesting some easing of last month's intense pressure. Despite this small positive shift, the industry continues to face hurdles. Exports, which involve selling goods abroad, are still dropping, and many companies are reducing staff. These signs point to persistent obstacles primarily due to weak global demand. It's worth noting that this survey was completed before Indonesia finalized a late July tariff reduction deal with the United States, which lowered import duties from 32% to 19%. While this adjustment could offer some relief, manufacturers remain cautious amid uncertainty as consumer spending and confidence circles the drain. Why does this matter to you? For investors and markets, this signals a cautious optimism. The recent uptick might seem promising at first glance, but the fact that the sector has been contracting for 4 consecutive months suggests that Indonesia's main industrial companies are still under significant pressure. Continued worries about export demand could weigh heavily on local equities and businesses linked to supply chains. However, if the recent U.S. tariff reductions stimulate more international trade, we might see a brighter outlook later in the year. Zooming out, what does this mean for the broader economy? Indonesia's current struggles mirror a larger trend among export-dependent nations grappling with global trade tensions and cautious consumer spending. The new U.S. tariff arrangement is a positive step towards improving supply chains, but a robust recovery likely hinges on an increase in global demand for Indonesian goods. For policymakers, maintaining employment levels and encouraging investment will be vital to fostering a sustainable economic comeback. And the question remains, will these slight improvements pave the way for a real turnaround, or are they just wishful thinking amid ongoing global uncertainties? Share your thoughts. Do these signs of life in Indonesia's factories signal a future brightening, or just a temporary respite before further challenges? Indonesia PMI drop, the 290 billion EV investment opportunity you missed. Warning signs in the global manufacturing landscape. Can Southeast Asia's supply chains weather the storm? As the world grapples with the unpredictable landscape of U.S. trade policies, Southeast Asia finds itself at the epicenter of a maelstrom, reshaping the very fabric of its industrial strategies. Indonesia, with its vast archipelago and 270 million strong population, stands at a critical juncture. The country's manufacturing sector, which has endured a 4-month contraction streak as of July 2025, SP Global PMI 49.1, is wrestling with anemic demand, escalating input costs, and the ominous specter of U.S. tariff threats. Yet, beneath this contraction lies a tantalizing paradox. Indonesia's strategic pivot towards electric vehicles, EVs, nickel-based battery production, and trailblazing digital trade reforms might just position it as a dark horse in the restructured global economy. The paradox of contraction. Unpacking the numbers. Indonesia's manufacturing PMI has seesawed between 46.7 and 49.1 in 2025, signaling a persistent yet moderating decline. The July 2025 reading, although still shy of the 50-mark threshold for growth, reflects a welcome deceleration in contraction compared to June's 46.9. Key pressure points include deteriorating new orders, the steepest decline since August 2021, driven by lackluster global demand for commodities and U.S. tariff uncertainty, which has manufacturers on edge. Stagnant exports, a 2-month slump in foreign sales, particularly to the U.S., where a proposed 232 tariff on aluminum and automobiles looms large, casting a long shadow over the industry. Input cost inflation. Despite easing to a 4-year low, firms continue to absorb costs to maintain competitiveness, a strategy that's squeezing profit margins to the breaking point. However, this contraction is far from uniform. Indonesia's EV sector, turbocharged by its dominance in nickel, a staggering 60% of global reserves, and lithium, has attracted a whopping $290 billion in projected investments from industry heavyweights like Tesla, BYD, and homegrown players such as Aneka Raya. The government's U.S. reciprocal trade agreement, which eliminated tariffs on a whopping 99% of U.S. products while securing preferential access for Indonesian EV components, has created a unique value proposition that's turning heads globally. U.S. trade policy, a double-edged sword for Southeast Asia? The Trump administration's America First trade policy has unleashed a complex mosaic of tariffs, ranging from 10 to 40% on goods from China and Brazil, to product-specific duties on aluminum and semiconductors. For Southeast Asia, this has meant a forced reconfiguration of supply chains, with far-reaching consequences. Take Cambodia's garment industry, for instance, which faces a crippling 19% U.S. tariff, risking 150,000 jobs and a potential mass exodus of migrant workers. Indonesia and Vietnam, however, have embarked on divergent yet complementary strategies. Vietnam's localization playbook, by localizing a significant 45 to 50% of textile production and securing a 20% U.S. tariff cap on exports, Vietnam has effectively insulated its manufacturing sector from the worst of the shock. Its July 2025 trade framework agreement with the U.S. further stabilizes investor confidence, sending a clear signal to the market. Indonesia's vertical integration gambit. By leveraging its vast raw material wealth to build a domestic EV ecosystem, Indonesia is boldly bypassing the U.S.-China semiconductor rivalry. Its EV battery plants, supported by Tesla and BYD, are now targeting a substantial 20% of global EV battery demand by 2030, a move that could redefine the regional supply chain landscape. Strategic investment opportunities in Southeast Asia, where resilience meets reward. For savvy investors, the takeaway is clear. In an era of trade uncertainty, resilience trumps efficiency. 3 sectors stand out as beacons of opportunity. 1. Indonesia's EV supply chains, a high-growth sector poised to capitalize on the country's strategic pivot. 2. Nickel-to-battery value chains. Firms like Vale Indonesia and Aneka Raya are expanding nickel processing capacity, with Tesla's $12 billion investment in a Jakarta-based battery plant expected to go online in 2026, promising a significant boost to the sector. 3. EV logistics infrastructure. The government's $60 billion infrastructure fund is targeting port upgrades and multimodal transport networks to support EV component exports, a move that will further policy tailwinds. Indonesia's 2025 SME stimulus package includes $40 billion in relief for EV-related SMEs, which account for a staggering 99% of the country's enterprises, providing a vital lifeline to the backbone of Indonesia's economy. Vietnam's semiconductor clusters. With $1.06 billion allocated to semiconductor workforce development, Vietnam is building a pool of 50,000 specialized engineers by 2030. Cementing its position as a rising star in the global semiconductor landscape. Global partnerships. Intel's Hanoi plant and Amcor's Penang operations are testament to Vietnam's ability to attract capital despite U.S. tariff risks, highlighting the country's enduring appeal to international investors. Thailand's EV logistics hubs, with its 1.5 million ton annual cargo capacity, is expanding to service Thailand's burgeoning E4W production, supported by streamlined EV component import rules, further enriching the regional logistics ecosystem. The path forward: diversification, vertical integration, and policy clarity. The U.S. tariff regime is not a temporary hurdle, but a structural shift in the global economic landscape. For Southeast Asia, the key to long-term resilience lies in diversifying markets. Vietnam's expansion into Africa and South America, and Indonesia's focus on India and Brazil reduce U.S. dependency and pave the way for more balanced trade relationships. Vertical integration, controlling supply chains from raw materials, nickel, lithium, to manufacturing EV batteries. Semiconductors minimizes exposure to tariff shocks, ensuring a more stable future. Policy clarity, Indonesia's U.S. reciprocal trade agreement and Vietnam's stable regulatory environment create predictable environments for capital, fostering an ecosystem conducive to growth. Conclusion, a call to action for strategic capital. Indonesia's manufacturing contraction in 2025 is a symptom of broader global turbulence, not a terminal diagnosis. By doubling down on EVs, digital trade reforms, and SME resilience programs, the country is laying the groundwork for long-term growth.